This is part 2 of using the acquisition method when a parent buys 100% of another company's stock, and we're going to look at goodwill and bargain purchases. Now, the acquisition method, the characteristics is valuation basis is fair value of consideration transferred, including the contingent consideration, but excludes direct and combination costs. Assets acquired and liabilities assumed are recorded at their individual fair values. Goodwill is the excess of the consideration transferred over the fair value of the net assets. Acquired in-process R&D is recognized as an asset, and professional service fees to help accomplish the acquisition are expensed. So now let's take a look at an example. We have Company A. They issued 10,000 shares of $1 par with a fair market value, and we're assuming that the first case it's $955,000, then $1.2 million, and then $880 for 100% of Company B's stock. So when we look at this, this is their book value, and we can see based on looking at this that they have some undervalued assets. They also paid $25,000 for direct legal and accounting fees, and there was a contingent obligation of $150,000 with a fair value of $50,000. Stock issuing costs of $10,000. Company B was dissolved. So the first thing we'd look at is what is our net book value. So we can see that the book value is $165,000 and the fair value is $1,005,000. So first we're going to look at what if the value of the stock, fair market value, is $955,000. So the first thing we're going to do is figure out what is the consideration. And here's the thing you need to remember: you need to add in the contingent obligation as part of the consideration. And that's the amount that's going to go to the investment account. Less the net book value of $165,000, which tells us we have excess over book of $840,000. We then have the difference for our intranet name, undervalued licensing, which is not on the books at all, and we have the in-process R&D that's not on the books at all. We add those up, we get $840,000, which means in this example we have no goodwill. Now let's look at the journal entries if it was dissolved. And here's what they would look like. You have the journal entries if the sub is dissolved, which we would book the assets at their fair market value, book the contingent obligation and the notes payable and the common stock, and also we need to do the journal for the stock issuing costs and the combination costs, and we need to credit cash. Now, what would the journal entry look like if the subsidiary had not been dissolved? Well, it would look like this. Investment in Company B would be $1,005,000. You'd book the contingent obligation of $50,000, the common stock at $10,000, and additional paid in capital at $945,000. Now, what is the goodwill if instead the total value that we paid is $1.2 million? Well, we're going to take that plus our contingent obligation. We're going to subtract the book value, which gives us excess over book of $1,085,000. And then we're going to adjust for the undervalued assets, and that means we have goodwill of $245,000. Now we can do our journal entries, which now include the entry for the goodwill of $245,000. Then we also again are going to do our journal for the stock issuance and direct costs. Now, what would it look like if it wasn't dissolved? It would be investment in B, $1.250, and contingent obligation, common stock, and additional paid in capital. Now, our last is what happens if we end up, the fair market value of what we gave them was $880,000. Well, we've got our $930 minus our $165 gives us $765 excess over book. However, our undervalued assets are 840, which means we have a gain on bargain purchase of 75,000. Now we can do our journal entry. We have to book the gain. Now, what you know, we book the gain whether we dissolve the company or we don't dissolve the company. So our journal entries, if not dissolved, we would have to show that gain on bargain purchase and adjust additional paid-in capital. And that ends this presentation on how do you get a goodwill, or what do you do when you have a gain on bargain purchase.